All right, everybody. Well, we are here in our second to last monthly update for 2025. I can't believe how fast this year has gone. But we're winding up the year, and we have a lot of really interesting pieces to be able to hit on in terms of where we are, what we think the next month and a half are going to look like as we close out the year. So excited to dive in with everybody. Just as an introduction, if you haven't attended one of these previously, my name's Jarrod Musick. I'm the CEO here at Destiny Capital and a member of the investment committee. So I'm really a thought partner to Tim, who will introduce himself in a second. And we love putting these on. We love putting together great content. So, please, if you have somebody else in your circle that would benefit from what we're talking about today, or sharing any of our previous episodes, please send those out to them. We're always available to be able to answer questions, so if they want to submit things to the CIO mailbag. And then a lot of times what we do, if folks want us to take a look at their personal investments, is we'll run an investment comparison. So kind of looking at some of our strategies versus things that they may be executing themselves or working with an outside firm to execute. So if that looks like anybody else in your circle, let us know. We'd be happy to run those and add value wherever we can. Tim?
Yeah, thank you, Jarrod. Yep, my name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital. I lead our investment committee here, as Jarrod mentioned, where we oversee capital market research, manager selection, fund due diligence, portfolio construction, trading, rebalancing, and I do put out a monthly investor letter along with our CIO mailbag, where I answer client questions throughout each month, and conduct webinars like this where we talk about what's going on in the markets and economy today, and where we see things heading. And we've got a lot of really interesting stuff to talk about today. So we'll get right to it.
As we're going to get right to it, we do have to hit some of our disclosures first. Highly regulated space and industry, so we have to go through these. Apologies for the 20 seconds this is going to take. Please don't make any irreversible decisions based on what we talk about today. Talk to your wealth advisor. If you already work with us, that's us. Reach out and talk to us. But CPA, tax attorney, other outside advisor, use the people that you have in your life before you make big irreversible decisions. I don't think we're going to talk about any specific securities today, but if we do, we may or may not maintain positions in those securities. And then Destiny Capital is a registered investment advisor regulated by the SEC. So all of our goodies can be found through the SEC website and our website, all of those things. So without any further ado, the government shutdown. The federal government is open, apparently, kind of, sort of. Tim, where are we at?
Yep. Yeah. Thanks, Jarrod. We touched on this in our last Markets and Economy update, and obviously it's been a big deal and something we've been tracking since the shutdown began in early October, but we do have a resolution, at least a short-term resolution for now. So after the longest government shutdown in history, President Trump signed a continuing resolution to reopen the government on November 12th. So generally speaking, that's a good thing, but we consider this to be merely what we would call, I guess, a temporary ceasefire. So resolutions haven't been met and agreements aren't lasting, but we've kicked the can down the road a little bit, as we normally do in the federal government. And this deal only funds the government at existing levels until January 30th of 2026. So right around the corner. So we'll be dealing with this in just a few months again. But in the meantime, the deal primarily funds, at least over a longer period of time, things like military construction, veteran affairs, agriculture, and so forth. So that payment has been extended. Furloughed employees are going to receive retroactive pay, so that's a good thing for them. And it pauses, this resolution pauses large-scale sell-offs or layoffs of federal staff. So there's some certainty around that. There won't be any mass layoffs, as was hinted at over the period of the shutdown. But from the standpoint of an investor, it has been disruptive. We're still not seeing the economic data that we're used to. So that's been troubling for us as an investment committee. That's been troubling for the Federal Reserve, which we'll touch on a little bit later in the webinar. So we're still not getting a full glimpse into what's going on in the labor market. We're not getting a full glimpse into what's going on with inflation. Obviously, two key areas, housing and so forth. So hopefully that data will get ramped up pretty quickly. But I do expect that data to be a little bit muddied as the federal government gets caught up with their surveys and everything that they're doing to collect that data in a timely fashion.
Mm-hmm.
So we're still not quite there yet with the data, but hopefully that is coming in short order. But some of this we may just have to take with a bit of a grain of salt in the next at least 1 to 2 releases, because we may not have the full scope of that data just yet.
Yeah. And the major unresolved issue here, and what we're likely going to hear lots about in the next 60 days coming up to that new deadline, is around healthcare subsidies surrounding ACA, right, Tim? So I know you've put together some information here. Why is that such a sticking point in the negotiation process right now?
Well, I think it's really just the cost that's being passed on to the U.S. consumer at this point. I put a chart to the right that shows the average annual premium for single and family healthcare coverage in the United States, and you can look at that trend line since the late 90s, and that has done nothing but move up and to the right. So right now we have, for an average family coverage in the United States, that's a cost of nearly $27,000 on an annual basis. That's just extraordinary for a lot of folks. And now that the ACA subsidies have been paused, for the first time, I think some of those families are seeing the true cost of that coverage, that underlying coverage passed on to them, and that's really really eye-opening for many employers across the country. Who provide healthcare insurance for their employees. They are well aware of these costs and have been for a while. It's extraordinary. But from the perspective of investors, really, if we have perpetually high insurance premiums, even if you do have coverage and you're just paying your share and your employer has coverage that they pay for you, if those premiums are going up and coming out of your paycheck, that really just leads to less discretionary income for you. And that could lead into slower growth for the economy, because 2/3 of U.S. GDP is consumption. So if the consumer can't spend and they're spending more and more of their dollars on healthcare and health insurance, that's just less that they can spend on goods and services. So that's something we need to be mindful of and watch. But it's a hotly contested item, obviously, in the government. I don't know what the solve is there. It's a highly complex situation. I think if we had an easy solution, we would reach it by now. But obviously, that's going to be a point of contention. We're going to have some votes on this, I believe, in the coming weeks. But something to keep an eye on, because healthcare really has gotten out of hand, and costs are really skyrocketing, and that's unfortunate. Anything else you want to add to that, Jarrod?
No, I think the argument right now seems to be, how much is the government expected to subsidize on healthcare, and where is that money going to come from? Because it's a massive portion of the budget when you add Medicare, Medicaid, Affordable Care Act subsidies, which are, I believe, passed through the states through a reimbursement program. I mean, there's just a lot of money that is tied up in healthcare, and trying to figure out how much gets spent and who gets taxed to be able to pay for that is a very sticky issue. So I think our expectation is it's probably going to be another large debate that kind of comes down to the wire here at the end of January.
Yep. Exactly.
So keeping with the cheery mood, along with massive health expenses, markets have turned a little bit bearish here in the last couple of weeks. Tim, do you want to talk about some of the indicators that we're seeing? And for those of you who don't eat, breathe, and sleep financial markets and investments, they call it bearish because a bear has claws and it pulls down. And then they call it bullish because when a bull hits you, it tilts its head up and tosses. At least that's the way that I've understood it. So bearish means we're looking at things being a little more negative. So Tim, can you talk us through what's happening right now?
Yeah, thanks, Jarrod. Yeah, good call out. I sometimes take for granted that everybody knows what bearish and bullish mean and so forth. But I think if anybody's watched the financial news over the last few weeks, they're seeing a little bit of a negative tilt. For the last couple of years, it's been nothing but, the AI bonanza, markets moving up, and we've really seen markets do tremendously since early April. Between early April and late October, markets moved up almost 40%. So that almost in a straight line, and that's really unheard of. But finally, we're seeing a little bit of a pullback. We're seeing a little bit of, when you watch the financial news, you'll see more negative news than you see positive. That's not uncommon. I think we all realize that. But there is some truth underlying that in the data that we're seeing. And some of that data we're going to cover here on this slide, which, first and foremost, we're not getting full data on this, but we have seen inflation moving higher. So we saw inflation kind of bottom out in 2025 in March with a 2.4% reading in CPI. That has since moved up to 3% as of the latest reading. We're seeing prices move higher for core goods. That's heavily related to tariffs and the tariff impact there. Food, that ties into tariffs as well, and energy. So with these prices moving higher, that really impacts consumer behavior, and both consumer behavior and Fed policy. And it's really interesting. In 2022, when CPI rose to over 9%, we saw consumer sentiment fall to its lowest level since the 2008 Great Financial Crisis. We once again hit those levels. So those 2022 levels and 2008 levels with, as of the latest reading, consumer sentiment fell to 50.3. That just reiterates to me how painful inflation is to consumers and how much that really irks them and has sentiment moving in a negative direction. So that's, when we're looking at consumer sentiment, we're looking at whether or not that's actually impacting consumer behavior. And we don't have a sense of that right just yet because we don't have retail sales data and things like that we would normally get from government reports. But if this sentiment is any indicator, perhaps we could see a sell-off or a decline in retail sales in the coming months. But then again, we've got Christmas coming up and holiday spending, so that could cover some of those wounds a little bit. But also, when we look at inflation, we see potentially the Fed growing a little bit more hawkish. When we say hawkish, we mean that the Fed is getting a little bit more conservative, meaning that they're not going to be as accommodative in lowering rates and attempting to grow the economy. If anything, when they're hawkish, they're attempting to constrict the economy and have growth be limited in the months and quarters ahead. So
I don't know why we just try and make everything into like an animal metaphor, right? So hawkish, like hawks hunt things and they kill them. So apparently that's bad. But if the Fed is dovish, I don't know what doves do that is so wonderful and good, but that means they're trying to make the economy easier, make money flow more easily. So they're hawkish. It means they want to be really focused on inflation and not giving us this easy money.
Yeah, we've hit all the main ones between bull, bear, hawkish, and dovish on this slide. So it's a good one. But if you think about investor mindset, just a few weeks ago, investors were assigning a 90% probability of one more rate cut by year end of 2025. Since then, because of the inflation data, because of the shutdown, because of the impact of tariffs and so forth, and more, we are now seeing investors betting that no rate cut is going to be coming in December. So that's a big shift. And when we see the Fed trajectory changing from what investors are expecting, we tend to see markets react negatively. And that's exactly what we've seen in the last few weeks. You could see this in the chart to the bottom right that shows recent stock market drawdown. So a drawdown is the move from a market high to the current low. And we see on the chart to the bottom right, both the S&P 500 and the NASDAQ represented there. So the NASDAQ is in a 5% drawdown. So it's moved from top to bottom 5% in recent weeks. And we've seen the S&P 500 move down 3%. This is changing by the day. I should be clear. This could be changing by the time many of you watch this webinar. But if you see the line that shows where the sell-off began, it's right at the Fed meeting. So the Fed met on October 30th, and right at that time is when the market sell-off began. So really interesting to see that markets reacting as normal to Fed policy, or what they're expecting Fed policy to be in the months coming. But at this time, investors are betting on no additional rate cuts in 2025, which is a change from what they were expecting just a few short weeks ago. Another item that has hit headlines in recent weeks is some news. Many of you may be familiar with Michael Burry. He was made famous by the movie The Big Short. He was the guy that bet against the housing market in the United States, made a ton of money. And he has recently made headlines by claiming that the AI hyperscalers, so Meta, Amazon, Oracle, Microsoft, you name it, all the big tech companies in the United States are inflating profits by extending the useful life of chips, servers, data centers, and so forth. This just has to do with accounting measures and depreciation. Michael Burry claims that the useful life of these data centers is more like 3 years, whereas these companies are extending the useful life to perhaps 5 to 6 years. And when you extend that useful life, it's less of a depreciation expense, which actually adds to the bottom line, so adds to profits. So he feels that they are inflating profits potentially through this kind of accounting measure, and that's gaining a lot of headlines. So I want to remind investors that Michael Burry also tweeted for all investors to sell on the 1st of January on 2023. So take his advice with a grain of salt. But it's just that's just an unknown. To be honest, it's an unknown. This technology is so new. We don't really have a grasp for what the useful life is. It's hard to imagine that they're going to be making these investments, billions and billions and billions of dollars of investments into something that is only useful for 2 to 3 years. They're going to have to get more out of that investment. So again, that's gaining a lot of headlines. So I just wanted to touch on that, but that's something that I think investors need to take with a grain of salt, because I think a lot of experts don't have a true grasp for what the useful life of some of this technology is. But they're obviously hoping it's going to be longer than shorter, given the investment that they're making. Jarrod, anything you wanted to add on top of all that?
Yeah, I think this is a good overview of probably what we're all feeling as investors, that, just the broad sentiment has turned into, hey, there's more headwinds or risks or things we should be worried about than there are things to feel really positive about. And that dynamic shifts several times throughout the year. And I think we all know when that's happening. So we're just in one of those periods right now. How much of that is valid, I think, remains to be seen. So I think, can we look at how this is happening and what's being experienced by a very risk on assets and what we're seeing right now?
That's what I thought would be good to cover on this slide. It's a good reminder, when investors are looking at certain assets that seemingly do nothing but go up, you have that element of fear of missing out, and when stocks or certain asset classes skyrocket, that can become really appealing. It seems like all they do is go up. But these are two examples of some asset classes and stocks that have sold off in the near term that are kind of a good reminder that things don't always go up, and fear of missing out can actually lead to some bad decisions by investors, because when you get in late, perhaps you're getting in at the wrong time, and quite often valuations do matter, and asset classes do sell off, stocks do sell off. So when volatility strikes, speculative assets tend to be significantly impacted, and we've seen that in two instances that I want to cover on this slide. One is Bitcoin. You could see that in the chart to the top right. We've had widespread institutional adoption of Bitcoin. We've seen the launches of spot Bitcoin ETFs, but still the asset class remains highly volatile. And we've seen a tremendous run up in Bitcoin to where it peaked at almost 125,000. It has since sold off since sentiment started to shift, and we've seen more of a bearish tilt, as we referenced on the previous slide. Bitcoin has since sold off to closer to 90,000. Right now, it's before I hopped onto the webinar, it's about 89,000, and this chart shows roughly 92, I believe. But still, a pretty big move to the downside to help remind investors just how volatile, even though it's gained widespread adoption and is becoming more considered an investable asset class. It's still one of the more volatile asset classes. And when risk sentiment turns, those are often the first ones to get sold off. Another is a little bit of a different case is Palantir. So Palantir is a company that builds software platforms for data analysis, AI, and they serve the government, defense, commercial clients, and so forth. And between January of 2024 and the end of October of 2025, the stock surged over 1,000%. So a huge move to the upside for that particular stock. That drove the company's market cap up to 400 billion. So an extraordinary move. Again, to me, this almost turned into one of those meme stocks when I looked at the trajectory of it. It was astounding to see the success that it was having and the move that it was having. To me, that wasn't necessarily supported by the fundamentals that I was seeing underlying stocks. So I provide two examples here of valuation measures. And when we look at valuation measures like price to earnings ratio and the price to sales ratio, I kind of tend to use those as a comparative analysis. So what is the price to earnings ratio or price to sales ratio of Palantir relative to competitors in the marketplace or other big companies, tech companies that might have a high valuation of 400 billion or more? So this company has a forward PE ratio of 234. That's extraordinarily high. The forward PE ratio of the S&P 500 as a whole is 22.3. The 30-year average PE ratio of the S&P 500 is 17. So this tells me that Palantir, relative to his earnings, is highly overpriced, and the price to sales ratio indicates just as much. They've got a price to sales ratio of 112, whereas a company like Microsoft has a price to sales ratio of 12.5. So again, the price is high relative to sales, the price is high relative to earnings, and that's a big red flag for many investors. Again, Michael Burry, that we referenced on the previous slide, mentioned that he has a heavy short position on this stock. When I say short, that means he's betting against this stock. He's betting that the stock is going to go down. So that's when you see valuations like this and valuation measures like this, it's hard to, it's easy to see why he might be interested in shorting a stock like this. But anyway, when we see sentiment shift, valuations tend to matter, fundamentals matter, and stocks like this can get hurt in the short term. And you can see that in the chart to the bottom right, where we saw the stock peak at over 200, roughly $207 per share, and it's down to about 170 now, and has been highly volatile on a daily basis. So just a reminder that fear of missing out can tend to bite investors when they get a little bit out too far over their skis with some of these investments and chasing returns and seeing that it seemingly certain stocks and certain asset classes only move up, and that we all know isn't always the case. So these are just two good reminders of that. Jarrod, anything else you wanted to add?
Yeah, I think when we look at our role as investment managers and then on the planning side of what we do as well, it's really thinking about how do you construct total investment allocations where you capture these gains in pieces, right? But you're not overly concentrated in any one position, which when the markets are going great, when sentiment is high, it can be hard to be disciplined in that. There's always this thought that, hey, we should really, add more here, or you go talk to your friend and they're talking about, hey, I was in at Palantir at $60 a share, right? Those are always difficult things to say no to. And so from our perspective, that's why we're looking at how do we build strategies which are viable throughout all seasons, where you want to be able to stay invested in most of the positions through most of the seasons inside an investment time horizon. So not saying that we're certainly going to see all the high risk on assets really sell off here in the near term, but we've seen some of that here over the last couple of weeks. And that's always the risk of some of these high flyers and having too much concentration there. So that's stuff that we highly recommend that you pay attention to.
Yeah.
So we wanted to close this out with, the good part. We spent a lot of time talking about negative sentiment, government shutdowns, inflation. How are corporate earnings looking as we wind up the year, Tim?
Yeah, we wanted to end with a positive, and U.S. corporations are certainly doing their part to keep the stock market elevated. Uh, we're about through with Q3 2025 earnings season, and earnings have really, almost knocked it out of the park based on the data we're seeing. We've had about 92% of S&P 500 companies report to date, and 82% have reported positive earnings surprises, meaning they beat estimates, they beat analyst estimates to the upside. That figure, that 82%, is well above the 5 and 10 year averages. So that's great news. They're beating on earnings, and they're also beating on revenues, with 76% of companies beating on revenue estimates. And that figure, again, is well above the 5 and 10 year estimates, meaning that, companies are beating on both the bottom line and the top line. And that's great news for the stock market. But moreover, we're really seeing record profit margins for these corporations. So at 13.1%, net profit margin growth has grown to the highest level since this data really has begun being tracked by a company called FactSet back in 2009. So you see that it highlighted in red on the chart to the right. Net profit margins have really surged and are very, very strong, and that's obviously a really good thing for investors. More so, we also have the earnings growth rate. So earnings growth rate is something that where we look at the earnings growth of the S&P 500 as a whole on a year-over-year basis. And ironically, year-over-year earnings growth rate for the S&P 500 again is currently 13.1%. That's an extraordinarily strong number. Coming into earnings season, analysts were estimating an earnings growth rate, annual year-over-year earnings growth rate of closer to 7.9%. So that 13.1 is really knocking it out of the park. If this number holds, and obviously at this point I believe it will, or at least will come in close to this 13.1%, that will mark the fourth consecutive quarter of double-digit earnings growth for the S&P 500 as a whole. Earnings growth is the primary driver of shareholder value, so that's clearly a good thing for investors. So, bottom line here, earnings continue to be really encouraging. Corporations are doing their part, despite what we're seeing in the overall economy. Clearly, as investors, we're forward-looking, but earnings continue to. Corporations are in really good shape. They continue to run themselves very strong to push earnings higher, revenues higher, and that earnings growth rate higher, margins higher. So across the board, we're seeing really positive news when we look at earnings season for Q3, and I think that's a good place to end it. Anywhere you wanted to touch on here, Jarrod, or anything you wanted to highlight?
Yeah, I think for me, the number one data point here, and maybe throughout our whole presentation, is when we talk about the PE ratio of the S&P 500 being elevated, right, at that 22 level. Part of what makes that a little bit less scary than it might otherwise be is the earnings growth rate. So, dependent on the assumptions that you make about earnings growth rate, the forward PE can look quite a bit better than what the current PE looks like. So, I think for me, it's, corporate profitability, corporate growth rates continue to look good. I'm not saying that the S&P is or is not appropriately valued currently, but I think when we look at risk factors, healthy earnings growth rate is really helpful and really positive for investors. So I think, as we always look, there's always a mixed bag of data. There are always things pointing down and up, and that's part of the long-term investing work that we do. But I think that one really stood out for me. So I think as we kind of look to close out our discussion for today, Tim, what would you want to leave our viewers with?
Yeah, I mean, it's easy to look at some of the high headlines today and get frustrated and discouraged. But just remember, it's important to keep a long-term investor mindset when going through times of volatility. We've had an incredible run in the stock market between April and the end of October. The volatility, the negativity, the bearish sentiment that we're seeing is completely normal. This can help reset the markets a little bit. If we see a pullback, historically, we've seen pullbacks and the markets just continue to plug along and move on a higher trajectory. So There's nothing to say that that won't be different this time. And it's just, yeah, important to keep that longer term mindset. And if you do have questions about your portfolio or your financial plan, that's when it's important to just reach out to our team. We can run your plan, see how things project out into the future. And often those conversations can be really reassuring and help you sleep better at night when the markets are doing their thing and selling off 1 to 2 or 3% a day. So I think I'd probably leave it there.
Awesome. Yeah, thank you everyone for giving us some of your valuable time. We have our CIO mailbag open for questions over at destinycapital.com. If we can help any friends, family, colleagues, even neighbors that you may or may not really like, we'd love to talk to those people. So feel free to refer them over to us, and we can always look at what they're currently doing and see if there's room to be able to do something different that helps them get to their goals faster. So thanks so much for giving us your time, and we will have one more of these coming out in December before the end of the year.
Yep. Thank you, everybody. Talk to you soon.
Thanks.